Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, over the next 4 weeks, we're going to replay the most popular episodes of 2025. And the first one that we want to share with you was an episode that we produced towards the middle of 2025 that talked about tax changes for the 26 financial year. And I'm a little bit disappointed, to be honest, that this is a popular episode because, I'm really keen for listeners to really focus on, not short-term wins, not these sorts of, how can I save tax this year, but more strategic, sort of longer term thinking, still around tax planning perhaps, but also, really about building your overall wealth after tax, being tax is only one consideration. Anyway, I think it's still important, that we keep up to date with changes and that we're still looking for opportunities. So that was one of the most popular episodes this year. And so let's get into it and we'll replay it for you. Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, welcome to a new financial year. It's something that Mena and his team get very excited about, probably celebrate too, which is pretty sad. The start of a new financial year. Got to get used to saying 26 financial year now. So anyway, we thought we'd spend a little bit of time just talking about all the things that are going to change as a result of the new financial year. There's always a lot of caps and rates and all these sorts of things that we need to be on top of. So let me start. We'll just take it in turns. The first really big change is the superannuation guarantee rate. So that's the mandated super contributions that you must pay on any salaries paid to employees. And in the 25 financial year, which obviously has ended, it was 11.5%. So it rises by another 0.5% to 12%. Now, there's no plans, at least at this stage, for it to increase beyond 12%. But, who knows what successive governments will do. But businesses have had to really wear a 3% mandated increase in employment costs over the last sort of 5-ish years. It's where it's increased over. So it's good it's great from an employee perspective, and I think it's good from a country retirement savings perspective, but not so good for businesses.
The next thing is no tax deductions allowed for general interest charges, or GIC, commonly referred to. So the ATO basically came out, and obviously the government is in a large deficit, so they have been charging general interest charges for things such as payment plans, sort of late lodgements and late debts and so forth. So generally these interest deductions were a tax deductible expense when incurred. However, from 1 July 2025, these deductions are no longer allowed.
So what is that interest rate? What do they charge, Mena?
The current quarterly rate is sitting around 10.7, 10.8%, so it is quite high. What generally happens though is if the interest charged on the debt is less than $100 per month, then it automatically gets remitted, and this is just a general guideline. It'll be interesting to see if that occurs after 1 July, but currently the rate as it stands is 10.78%. So sometimes it might be best to actually get external funding if you need to pay your tax debt, because at least that way it's tax deductible and it'll be probably more likely be at a more favourable rate.
Yeah, because obviously if that 10.8% is not tax deductible, then really you're looking at an after-tax cost of debt at much higher compared to, if you borrowed from the bank at 10% and got a 30% deduction, your after-tax cost is 7%. So it's just not worth really paying GIC anymore. And if you've got a tax debt, you've really got to, it's economical to find other means of paying for that debt. Good on the ATO. Okay, so the next one is the energy rebate. It was extended in the federal budget. It's not a big deal, but businesses benefit from that. So there will just be one more payment of $150 in the last half of the 25 calendar year. Nothing you need to do in regards to that. That just comes through on your bill.
The next thing is around home batteries, which is a great initiative by the federal government, I believe. They're subsidising the cost of batteries associated with obviously solar installations. So a typical home battery will be discounted by roughly about 30%, saving around $4,000 roughly on a typical battery. I worked it out to be roughly about $350 per kilowatt, up to a max size of 50 kilowatt battery. So it's quite a game changer. Makes the payback periods on these home battery systems a lot quicker.
And also just general solar panels really too, Mena. If you can then, if it's more economical to get a battery, you can then store the power. It probably makes getting solar panels more economical.
Definitely, and even if you do have solar panels at the moment, the feedback rate into the grid, or the rate that feeds back into the grid from your solar panels, is significantly reducing. So, having a battery makes a lot more sense.
Next one is instant asset write-off. We're pretty sure it hasn't yet been legislated, but it was part of the budget for it to continue to be extended, which means that you can expense up to, an asset up to $20,000 in the financial year in which you pay for that asset and implement it in your business. But if that is going to impact you, best to make sure that that's going to be legislated. I don't think it's going to be a problem. The current government controls both houses, but something to just be sure of.
There's been a few changes to pay-as-you-go withholding cycles. Employers with an annual withholding from their employees' wages of $25,000 up to $1 million will be going to a monthly lodgement instead of a quarterly lodgement. Now, any employers that withhold more than $1 million per year, now the ATO will be requesting payments every 6 to 8 days from the payment date. So it's no longer monthly. It's basically as soon as the payment's done, pay-as-you-go needs to be withheld within 6 to 8 days post that payment. Now, this is a move by the ATO to get them to basically same-day super as well. We're expected to see that in the next couple of years, where the ATO will request that the day of the payment of your general staff wages is also the day that you'll remit your employee super, instead of it being quarterly.
Next one is payroll tax. No major changes in most states except Victoria. Payroll tax threshold increases from $900,000 in the 25 year to $1 million. So an extra $100,000. Let's not all rejoice too quickly though. New South Wales is 1.2, Queensland's 1.3. And if anyone wants to start a business in Northern Territory, that's the best place to employ people. It's $2.5 million, Mena, before you pay payroll tax. So, certainly Victoria still retains its anti-business mantle, I think, but at least some small relief there for business owners.
The next thing is around luxury car tax rates and thresholds. Now, this is usually a topic that most people like because, it gives them a luxury asset to enjoy. But the luxury car tax threshold for fuel-efficient vehicles, so EVs, is going to be $91,387. So previously what was happening was a lot of the EVs wouldn't fall under the luxury car tax threshold, so not a lot of companies could benefit from the FBT exemption associated with that. But I believe this new threshold encompasses a lot more vehicles, which is great. And for general combustion vehicles, it's up to $80,567.
Teslas are getting cheaper and cheaper, so it should be should be
Exactly.
fine. The next one is transfer balance cap is indexed, and so the transfer balance cap is the amount that any individual can have across all their superannuation accounts if they've got multiple. That is tax-free in retirement. So that's increasing from $1.9 to $2 million. And that is legislated to continue to increase. It's a big planning opportunity here too, by the way, because when we do financial projections, we can work out, for example, when our clients are going to retire, we expect the transfer balance cap to be, say, $2.5 million, which means if they've got a spouse, they can have up to $5 million of their net worth inside super and not pay any tax. So the indexation of the transfer balance cap is a good planning opportunity.
Also, just a reminder to lodge your Single Touch Payroll finalisation by 14th of July. It's always a good precaution to just test what's actually been lodged in your STP finalisation to your year-end payroll summary report. Sometimes there are mismatches, especially with softwares, not to discredit these softwares, but software such as MyOb and QuickBooks, there tends to be some discrepancies. So always best to just double check that before you complete your STP finalisation. And also, if you're registered for payroll tax, make sure your year-end reconciliation is done before 21st of July.
And lastly, PAYG variation. That is if you want to vary the amount of tax that's taken from your salary. So this is most appropriate for people that have other tax deductions. The common one is investment properties. So if you've geared investment properties, instead of waiting until the end of the financial year to get your big tax refund, what you can do is lodge a PAYG variation and your employer will subtract less tax out as something your accountant can help with. But it's something you need to do each year. So if you've done that in past years or you want to start doing it this year, that's something that you need to think about. Okay, so there's plenty of changes coming our way for this new financial year. We just thought we'd cover them all. Hope that's been useful. And until next week, bye for now.